This is Trader's Workshop with Adam H. Grimes. Hello, welcome to episode 4 of Trader's Workshop, How to Think. I'm your host, Adam Grimes, and you should follow me on Twitter at Adam H. Grimes. It's kind of a central point for all of the work that I do. If you follow me on Twitter, you'll know what's going on. Okay, so how to think. My gosh, what an arrogant and pretentious title for a podcast, right? But I hope you see it's at least a little bit tongue-in-cheek, and I think this is really important. I've become convinced even more over the past 5 years that many people who struggle to learn to trade, who struggle with trading, could succeed, but they struggle and they eventually fail because they don't understand the game they're playing and they don't even understand how to think about trading problems. So that's what we're going to talk about here. Of course, to tell another person how to think about anything is incredibly pretentious, but there are tools, there are structures, there are ways that we, from other disciplines, that we think about problems that are not completely dissimilar to trading. You know, trading is such a strange universe, and the things we do seem so very incredibly strange, but there's good precedent in other aspects of research and aspects of science. There are ways that people think about problems like this. So, brief outline of what we're going to do today. We're going to discuss the question, does it work? And we're going to see that to answer that question, you need to think statistically. We're going to talk about what that means and how to do it. We're going to look at how the market works against your learning. And then we're going to see how we are buried in so much misinformation. After we do that, we're going to talk a little bit about the allure of magical thinking and conspiracy theories. And I'm going to show you the framework that I use to justify my super critical approach to trading ideas. And I hope that at the end of this, you'll come away with some more food for thought. If you already approach trading in a kind of scientific approach, you'll probably see a lot of what I say reinforces things you already thought. Maybe that's good, maybe that's bad. But if the things that I say here today are very new to you or really challenge some of the ways you're thinking about trading, and if you're also struggling to learn to trade, stop and rethink and use this podcast as a challenge to kind of set a new course for yourself, set a new direction. Okay, so let's imagine that we have never traded before and we discover this thing called trading. We all were there at some point, right? One way or another, there was a point where you knew nothing about trading and then you learned a little bit. And then imagine you go to a friend and you say, hey, people are trading crude oil futures on 5-minute charts. People are buying marijuana stocks. People are trading inflections on the vol surface, arbing time and different strikes, whatever, right? And you tell this person, I'm going to make so much money. Now, if this person is a good friend, what is she going to say to you? What's the first thing she's going to say to you? If you're the kind of friend I want, you're going to say, well, does it work? And of course, you're going to, no, people, like everybody's, and she's going to say, wait, how do you know it works? Does it work? And then if you think about it, that's actually quite a deep and difficult question. And to really answer that question would require a course in scientific thinking, a course in statistics. But I'm going to give you some guidelines here and some ideas for directions to think about this. So this question, how it works. First of all, does it work? This question is thorny because we have to apply it to the process. We have to apply it to our entire trading program or trading career even might be a way to think about it. And this is difficult because if you go hang out in Facebook groups, people are going to be talking about really, just some of the things people talk about. They'll be talking about marijuana stocks. It's very popular right now. I hope you are still finding this podcast years and years down the road. But here in the middle of 2018, with the shifting legal environment, that's really a focus. People also will talk about very cheap stocks. People will talk about, for instance, energy stocks, oil stocks that have some access to some specific field, or natural gas. There are all of these reasons that people might say, hey, go buy this stock. But the problem is that's one event, right? And it is a little bit difficult to assess. If you are telling me, hey, you got to go buy these marijuana stocks, and here's why, and you give me a list of reasons why, that's a difficult thing to assess, because we've never been in this regulatory environment. We've never been in this spot culturally. We've never seen these businesses evolving, and you have never navigated this environment successfully, because nobody has. This is completely new. So how am I to evaluate your input? And that actually is one reason why I have tended to develop processes that really focus on internally consistent things. I don't want an expert telling me what to do, because I don't think there are reliable experts. That's obviously an entirely other subject that we will cover. But what I really need to think about is, okay, so buying these marijuana stocks now, the way I'm going to think about this problem, the way I'm going to assess this problem, is the same way that I might have thought about buying manufacturing stocks, maybe buying pharmaceutical stocks, maybe even buying retail stocks. It's that I have a process, a way that I evaluate trading ideas, and then I decide if I am going to do it, what do I risk? How much do I risk? How do I control my risk? How do I take money off the table? Am I buying something and hoping for it to go up 40 or 50 times? And, by the way, there might be a reason why you might do that. I'm not saying that that's not legitimate. Or am I looking to hit a lot of singles? And if you are, for instance, if you're investing in these marijuana stocks, that's probably a mistake. Nobody thinks you're buying a 50-cent stock looking to make 75 cents. On the other hand, if you want to step into my world and day trade S&P futures, you might very well be looking to make a few ticks. So it's a completely different mindset, and you do realize that you can only answer your friend's question, does it work, which is the right question, over a large number of trials. And one of the problems is that the things we think about are many times isolated events. So we have to frame the question in terms of repeated trials, repeated events might be a way to think about it. And this allows us to bring statistical tools to focus. And I'm not going to get really deep into math, but a few things to think about. We are talking about expected value. And this is good. This is really a way that I think the trading dialogue has evolved, because I'm betting most of you, when I say expected value, you already kind of checked out because you know what I'm talking about. If we'd been having this discussion 10 years or more ago, you probably would not have known so quickly what I was talking about. And just in case you don't, expected value means if I make a bet over and over, it's what I expect from the average of those bets. For instance, let's say you and I play a game. We have a fair coin, and we verify the coin is truly fair. It comes up heads 50% of the time, comes up tails 50% of the time, never stands on its end. That's a possibility you have to consider. And let's sit down, and every time the coin comes up heads, you pay me $1. Every time it comes up tails, I pay you $1. Now, it's pretty easy to think about that, right? Think about it from your perspective. And I don't remember how I structured the game, but did I say heads, you win? Anyway, okay, so that's the framework now. Heads, you win. So it will come up heads 50% of the time. 50% of the time, you win $1. It will come up tails 50% of the time. 50% of the time, you lose $1. And it's pretty easy to see that if we sit and play all day, that neither one of us is really likely to make money. There certainly, and the kind of interesting thing is, at any point, one of us is likely to have more money than the other. And if we play a long, long time, one of us is likely to get a much bigger pile of money than you would expect. That's a little bit counterintuitive. The expected value of that bet is 0. Meaning that if we do it a lot, you're not going to gain, you're not going to lose, because 50% of the time it's +1, and then 50% of the time it's -1. You add those, you multiply those, and then you add them together, and you get 0. I don't want to really get into the math, but imagine we change the game a little bit, and let's say when it comes up heads, I pay you $2, and when it comes up tails, you pay me $1. Now, how hard do you have to think about that? Are you going to play that game? Absolutely, because it's very obvious that you're going to very quickly build up a big pile of money and I'm going to lose consistently. I would have to be an idiot to play that game with you, right? And so this is how we think about trading ideas. We assess them in terms of, hey, if we do this over and over and over, what's the average outcome likely to be? Now, it doesn't say anything about any one time, because it is completely possible that we might sit down with that second game, comes up heads, I pay you $2, and you flip a tail, and you pay me $1, and you flip another tail, you pay me $1, and you flip another tail. Now that's, it seems a little bit unusual, but it's not actually that unusual. If you don't believe me and you have a few minutes, just flip a coin, see how many times it comes up heads or tails in a row. So right away, you're playing a positive expectancy game, but you have lost money. That's okay. That's normal. But if we keep playing, that situation is extremely unlikely to continue. So we do need to think and to assess the expected value. And this is what a lot of our system construction, a lot of our back testing, a lot of our statistical testing is designed to understand what edge there might be, what expected value a pattern or a trading methodology might have. It's quite, and now to go back to the marijuana stocks, and I'm just using that because it's a good example, because it's very much in the news, and it's also a good example of something that's a little bit hard to assess in this framework. Because it's one thing if we're looking at buying when price touches a moving average. Well, it's quite easy for me to go and get thousands of price bars and say, hey, when price touches the moving average, this is what happens. And it's relatively easy to say, to look at that and talk about it and think about it and say, okay, well, that's what happened in the past. Is this what I expect to happen in the future? And there are ways we can answer that question. Without getting too much into back testing, one thing we might do is we might cut the back test up. Let's say we back tested over 20 years. I might look at each 5-year period and say, do they kind of look the same? Really great thing I could do is do my back test, but then let's watch it for 1 year going forward, and let's see if going forward looks something like the back test. So we see if it actually carries forward into the future. That's one way to assess. How would you replicate that with the idea of buying marijuana stocks? Quite difficult, right? We could go back in time and find other, let's say, revolutionary technologies. Not that this is cutting edge revolutionary technology, but it's something that is becoming accessible, that in this case, because of legal concerns, was not accessible before. So it's a new market opening up. And so we might find parallels, we might find things to think about, but we might also reasonably ask the question, how good are these parallels? You see, it's quite a difficult thing to assess. So if you choose to, and this gives you some insight into why I have decided to build a career out of trading patterns and out of trading things that I can, at least in some sense, replicate. And that's another discussion too. See, there's so much fuel for future podcasts here. One of the things that I also need to tell you, my example about sitting down and flipping the coin is absurd in the context of real markets. Why? Well, if you've been listening to my podcast or if you know my work, markets are very competitive. if markets are very competitive, those edges are very small. So what a game might look like in the market is we sit down. If it comes up heads, I pay you $1. If it comes up tails, you pay me 98 cents. So you see, what I'm saying is it's a much smaller edge. Or another way to play the same game, let's say that we have a coin and it comes up heads 53% of the time, almost 50% of the time, but it comes up heads just a little bit more often. It's not a fair coin. So now let's play that game. And if it comes up heads, I pay you $1. If it comes up tails, you pay me $1. You're still going to make money, but it not nearly as quickly and not nearly with that degree of assurance. Because with my naive version where I pay you $2 with a fair coin, you pay me $1. If we flip that coin 10 times, you're probably going to have money. With a very high degree of reliability, you're going to make money. With the scenarios like I just laid out here, you don't really know. In fact, you might flip the coin 30 times, 50 times, and you might not have money, or you might not have enough money that you can say, hey, am I really making money? Is this really working? And that gets us to what happens in the market, because the good edges that are there in the market are quite small. And because they're quite small, it's hard to see them. It's hard to be sure they're even real. And you add to this point 3 for the podcast, the market works against learning. How and why? Well, for one thing, the market environment is incredibly emotional. I talked a little bit about this, and I've talked about this. To me, it's one of the core experiences of trading is dealing with the emotions of trading. And it's worth talking about because it's almost a universal experience. There might be somebody who is wired differently enough psychologically that they do not experience those emotions. That person probably exists. There probably aren't very many of them. I have a friend who's a mental health professional who is convinced that anybody who is a natural trader has some serious personality deficits, tending toward different kinds of psychopathy. That I guess the news here is if trading is hard for you, well, maybe that's good. If it was natural, then you're processing information in a way, at the very least, that's different than how most humans do. The market is very emotional. The market is competitive. Do you see why I set this up at the beginning of the podcast? If you understand that we exist in a framework where the market is extremely competitive, then you realize that price movements are caused by the competitive action of other traders. That makes sense, right? If you have people in a market who are trying to profit, whether going up or down or even sideways, you have a lot of people who are looking at the same data, who are making mostly intelligent decisions, but some decisions are emotional. There certainly is a follow the crowd mentality. And with our marijuana stocks, that's kind of what we're hoping for, right? We hope that when these start to move, that everybody in the world will realize, I got to get on this train. Oh my gosh, I'm missing out. And people will just buy in a panic, and that will make the stock go up. That's what we want. And by the way, I say we, I don't actually trade these, but just to put ourselves in the framework of somebody who does and is thinking about that. There is that behavioral aspect, the emotional aspect, in addition to the analytical aspect. And many times we think about trading as if, in the first part of this podcast has been very intellectual, very analytical. But the process of trading is both analytical and visceral. It's very emotional. And because the edge is so small, remember our coin that comes up heads 53% of the time? Well, it means it's going to come up against you a lot too, right? If you were explaining to somebody, you'd say, I win just about as many times as I lose. Maybe I win a little bit more. The problem with that is that these events are learning opportunities. And by events, I mean your trades, your investments, whether you win or lose, that is a learning opportunity. Now, in the normal world, Let's say I want to learn to make good bread. And that's been a passion of mine for years. That's probably, I'll really try to keep the podcast focused on finance, but I'm very much into cooking and baking. And I just started this adventure of grinding my own flour. My wife is very understanding. She puts up with a lot. And if I want to make bread, then I can very quickly evaluate each experience and say, oh, the temperature needs to be different. The time needs to be different. I need a little bit more moisture. I need to remove this aspect of the flour. I need to change this. And I can see the results are tied quite closely to events that I do. Let me say it better. I can see that the outcomes are tied quite closely to my actions. In fact, it would be very, very unusual for me to have a complete failure and if I've done everything right. In the trading world, that is normal. I can do everything right. I can find the perfect pattern. I can put the trade on at exactly the right time with the right risk, and I can manage the trade appropriately. And then that market can have some cataclysmic move against me, and I lose 5 times what I thought I was risking. I made no mistake. And in fact, what I should do if that same trade comes up tomorrow, I should take that same trade. But how am I going to feel after I just got kicked in the head doing exactly the right thing? I've had this powerful and emotional. All of this stuff is emotional because I lost money. I look stupid. I feel stupid. And I lost money. That's a powerful reinforcement, but it's completely wrong. And that's the problem. The market is, if you can imagine, okay, well, I use this example in my first book. Let's say that you're a young kid in school and something is wrong with your teacher. Doesn't matter what you do. You might do your homework exactly right, perfectly, beautifully. You might create a beautiful piece of art, and your teacher just screams at you and tells you how worthless, how stupid, how hopeless you are, and that you should just give up and you shouldn't even come back to school tomorrow. That's what it feels like some days in the market, right? Have you been there? If you think I'm being a little harsh, you probably haven't traded very long, because the market has said that to me many, many times over the course of my career. On the other hand, let's say someday you just phone it in. You're supposed to create an art project. You've had 2 months to work on it. And what do? You bring her a popsicle stick and you just throw it on her desk and she praises it. Oh, this is the most beautiful thing. Well, you can certainly do that with trading, right? In my situation where I set up the perfect trade and I did everything right, you could have some guy who I will uncharitably at that moment in time certainly think of as a complete idiot who does exactly the wrong thing and ends up making a lot of money. And in fact, that might be his first trade. I've got literally tens of thousands of trades under my belt. I've been doing this for more than 20 years, for most of my adult life. I have spent so much of my waking conscious time thinking about the market problem. I've traded in so many different formats and contexts and instruments. Like, it's hard for me to imagine somebody having spent more time both educating themselves and experiencing markets than I have. And it is completely possible that somebody walks in off the street with a $500 Robinhood account. Robinhood is a free stock trading app, and completely blows me out of the water on one trade, maybe even 2 trades. Maybe even a week, though we're beginning to get a little bit less likely there. That is completely possible. And how do you think that person would feel? That person would feel like a genius. That person has had a powerful reinforcement of, maybe they just did something completely wrong. Let's say they bought very expensive out of the money options, which if you do over and over, and by very expensive, I mean in terms of implied volatility, if you do that over and over, you're going to lose money on that trade, but it worked out for them in this case. So what's happened? Learning experience. And we just have to be prepared for this in the market. And it's quite difficult. It's difficult to approach this with the right mindset and the right perspective, because this isn't an intellectual abstract thing. This is an emotional experience. And many of you, I think, listening to this, when I was talking about that child, right? You probably had a little bit of an emotional reaction. and you thought, what a horrible thing to do to a child. Who would do that? Who would berate a child and say you are stupid, hopeless, worthless, and you should never do math again because you can't do it? There's no way you can succeed at this. In fact, you can't succeed in life. When I say that, and I'm exaggerating a little bit there, you're probably having an emotional reaction, at least a little tiny emotional reaction. Well, that's what happens in the market because these are such high consequence decisions. And, it's money, and money to us in the modern world is the resource that upon which everything else rests. It's not only money, but we also very easily can tie in ego and sense of self-worth into all of this. So it becomes a powerful and emotional thing as well. And so we have to overcome that. And that's where I'm going to wrap up this episode. So in the next episode, which will be a follow-on, I'll recap all of this a little bit, and I'm sure I'll go think about this for a few days, and I'll think of things that I could have told you even better. So I'll summarize and polish up a little bit of this, and then we'll look at magical thinking and conspiracy theories, and we'll see how that goes wrong for people. And I'll talk about why one of the things that has distinguished my work is a very critical approach to trading ideas. And frankly, I think this makes me a little bit of an unpleasant person sometimes because people like to exchange trading ideas, and my immediate inclination is to criticize and to not accept. And it certainly makes it hard it's made it hard for people to work with me. And if you're listening to this, I'll apologize. But I am still like that. And I maintain that framework as a conscious decision. And I'm going to tell you why, and I'm going to tell you why you should too. And then we'll wrap up the next episode with talking about application, because we just talked about a lot of theory. Well, how does this actually shape and affect what you do? That's going to be the question next time. So we'll wrap up here. As I said, follow me on Twitter at Adam H. Grimes. I do tweet. I won't bury you in tweets, and I like to think that everything I tweet is pretty important, but I'm sure that's not quite as true as I think. Also, I'd love for you to check out my two firms, marketlifetrading.com, massive trading course there. Go check that out. And if you want more of a traditional, let's say, research process, check out Talon Advisors. That's Talon, like a bird of prey, Talon, Talon, talonadvisors.com. Both of those have free trials. Both of those have completely money-back guarantees. And actually, marketlifetrading.com, if you hate it, I'll give you back more money than you paid me. So how often do you, everybody will say, we have a 100% money back guarantee. We have a more than 100% money back guarantee. I'm that confident in the quality of what we do that if you hate it, I'll pay you for looking at it. So go check it out, marketlifetrading.com, also talonadvisors.com. And last, as I said, Twitter at Adam H. Grimes, and check out my blog, adamhgrimes.com. Very last thing. Wherever you found this podcast, please subscribe, please leave a review. If you leave a 5-star review, that would be fantastic. But whatever you're inclined to do, and tell your friends about it. And also, if you have questions or ideas, I try to be pretty accessible. Twitter's a pretty good place to reach me. And I've done a lot of blog posts, a lot of podcasts that are generated by your questions and your perspectives. So we'll wrap up here. I'll see you back for the next episode. Thank you very much.